Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Wednesday. It's June 15th. The month is about halfway over. Let's get into today's market action. As you can see here, the Dow's up about 154, while the Nasdaq is up over 100, which is telling us right now easily that the Nasdaq is showing a lot more strength than the Dow, because the Dow's valued at about 30,500, and this is only valued at 11,447. So 100 points here is a lot more than 150 points here. So that tells us that the techs are leading ahead. It's really interesting, actually, because when you look at the broad stock market over a month, you still got the energy, industrial, basic material, healthcare, right? The most defensive sectors right here outside of utilities. But look at it yesterday. It says today, but obviously today hasn't traded yet. Information technology, energy, consumer discretionary. I mean, you can't make heads or tails out of this. You've got energy and information technology rising yesterday. If you look at it on a 5-day basis, again, you've got more defensive here, but look at where consumer discretionary is. Look at where information technology is. Look at communication services. They're starting to come up. That's bullish. That's bullish, and that's telling us the market is pricing in this drama that we're seeing right now with the Fed. A couple of other factors. Put the call ratio still, as you can see here, it's at 113 right now, still near very high escalated levels. The consumer discretionary sector was not able to break down the low. Very positive sign. This is a very positive sign that the markets are bottoming out, because you've got the weakest sector. Let me just show you here. Because you've got the weakest sector, which is consumer discretionary, holding up the high below the previous peak high, while QQQ broke the high. Broke the low. I don't know why I'm talking about highs. I should be talking about lows. Oops, let me just point that out. See, broke down. This low is higher than this low. Dow Jones, the low here is higher than this low. On the S&P, the low is lower. See that? Lower lows. But look on the weakest sector, the consumer discretionary sector. The low is higher. Very significant. Very significant. Put the call ratio, very significant. Most significant, and folks, if you want to see one picture, and this is worth more than 1,000 words, this is the Nasdaq 100 and the number of stocks trading above the 200-day moving average. During 2008, we dipped to 4 or 5%, or 4 or 5 stocks, because there's only 100 stocks in the Nasdaq 100. Look at where we're at right now. So just want to give you a perspective. This is COVID. This is the last time Fed raised rates. This is 2008. We're not in that bad of a situation right now, economically. And look at where we're at. So if you think this market's going to drop another 20% or 15%, I don't think so. Also, notice the rate of interest rates. Look at the rate. This is something nobody's really talking about, but really important. Look at this downslide here, right? If you look at this downslide, and if you look at tech stocks or consumer stocks, look at that. They peaked out 11.22. Interest rates peaked out 12.3. There's no consumer discretionary stocks going down, bonds going down, interest rates going up, puts the most pressure on consumer discretionary stocks, right? Well, treasuries broke down. Consumer discretionary stocks did not. And remember, we've been going sideways for 2 months now. So this slope, this down slope, or this increase in rates is flattening out. And that's telling me right now that this downside may be already priced into the market. And when you take into account that volatility, VIX, we made a lower low in all 3 major indices, as I just showed you. Volatility couldn't sustain that. Consumer discretionary could not sustain that. That's very meaningful. And that's telling me that most of the bond increases are at least priced into the market, even 3/4 of a basis point. Now today, we've got retail sales coming out in about 28 minutes. This is going to be a huge report, because this is going to reflect on consumer sentiment and last week's CPI, which caused the market to fall down. Then we've got FOMC announcement. This is going to decide our fate in the near term. If the Fed sets 3/4 of a point, I think now if they say half a basis point, the market's going to rally because the market's expecting 2/3 of a basis point. And remember, we still have about 300 points we have to fill in. That's what the market's expecting between now and the end of the year. So the fact that we're going to go up 0.75 now or 0.50, it's all about 300 basis points between now and the end of the year. Tomorrow, we've got jobless claims, housing starts, and permits. This is going to be very important in light of everything, a lot more important than the jobless claims, because housing starts is an issue. Jobless claims just rallied one notch up. They're still near historic lows. Housing starts, that's a big question. Industrial production, probably the second most important report this week. And then Mr. Jerome, I'm not going to predict the future. Oh, wait till I am. And I'm going to get it wrong every time. Powell speaks at 8:45. Sorry, I've been really tough on this guy lately. The FOMC today is going to be very important, but honestly, I think it's already pricing in 3/4 of a point. And I think anything below that, or even 3/4 of a point, may cause a rally in the market. Once again, the fact that consumer staples are holding up, the fact that volatility is not breaking higher, even though the stock market did, the fact that momentum levels are near their all-time lows. I mean, literally, when I say all-time lows, we're in the second lowest level in 20 years. And if you look at the S&P, let me show you the S&P. It's something else. Oops, that's sector. Let me show you the whole 9 yards. You got to see this. I mean, this is a sight to behold. This is 20 years. Look at where we're at right now. I mean, look at where we're at right now. This is 2010. This is 2008. Look at where we're at right now. So, folks, 5% of stocks in the S&P are trading above the 50-day moving average. So, the way I'm looking at things right now, this market is really, really stretched out. Now, we may go up and stay around these levels. We may do this for a couple of months. That's all there. But in terms of going much lower, I just don't think we're there. Excuse me. Now, let's talk a little bit about global economy. Traders expect the Fed rate hike to be 3/4 of a point or triple the usual margin. They worry aggressive action to cool inflation that's running at almost a 5-decade high might tip the biggest global economy into recession. I don't think so. I think we're pricing it in. Expectations of an unusual big rate hike increases after government data showed consumer inflation accelerated in May instead of easing as hoped. That's a big, big issue. The Fed is scrambling to get price under control after being criticized earlier for reacting too slow to inflationary pressure. Powell, I don't know what you've been pulling here. And markets have also been jolted by Russia's attack on Ukraine, which has pushed oil prices to historic making highs above $120 a barrel, and by virus outbreaks in China that led to closure of factories and disruptions. Not good, not good. I'm hoping that today we can get a little bit of a relief rally from all of this. As I said, the S&P is opening up a little bit higher, and I believe we're going to be going higher over the near term. The futures market right now is up about 130 points on the Nasdaq and about 226 points on the Dow. It'll be very, very interesting if we can maintain that through the retail sales report that's coming out in about 24 minutes. And to give you some idea of what they're expecting, honestly, anything positive. Now they're expecting 0.1. A few days ago, it was 0. Anything positive, I will take right now. The better we can get to the upside, the better. Not really concerned about vehicles. I just want to see the whole number being positive. If this number is negative, it's going to put a drag on the market. And then the Fed will say, well, we told you so, retail sale, consumer activities, we need to spruce it up. Things are not looking as good. So I'm happy if the number is positive, and that's coming out at 8:30. Pay attention to the bond market today. If the bond market starts going higher, that's bullish for the market. Keep your eye on major indices. Keep your eye on volatility. If volatility continues breaking lower, and starting to fill this gap, that's a very positive sign for this market. Now, I've got a bullish trade for you and a bearish trade. The bullish trade is Lantheus Holdings. This is a small cap stock. It's a medical stock, I believe. Let me just double check. diagnostic, in vitro, vivo diagnostic. Medical stocks are pretty good right now. PE ratio is not bad. Forward PE ratio is twice as good as its current, so it's making money. 3-year return is good. Revenue growth is solid. The stock, look at these earnings per share growth. The numbers looking really, really good. Not a big cap stock, but I like this stock right now. I like how the 5-day RSI, that's a 10-day RSI. The 5-day RSI is actually below 30, which is a pretty bullish sign. And I like how it's pulling back, and it looks like it's going to start going higher. So I like the stock. I like it at the current levels. I would put maybe a stop like around the 55 level, but I do like the stock, and I think it's going to go up to the 73 level. And to the short side, Chewy. Looks like COVID is dying. It looks like people are going back to stores, and this stock looks like it's going to go lower instead of higher. It just doesn't look like there's anything pleasurable in sight here. It started going down all the way in last summer. So I'm not seeing any reprieve or any love from this stock. So to the short side, definitely Chewy, and to the long side, Lantheus Holdings. Now, before I let you go, folks, if recent headlines about inflation and possible recession have you worried, you're not alone. Before you think about going cash, why don't you give my brand new style of trading a try? It doesn't require any sort of fundamental analysis or technical indicators. Most importantly, it crushes it in a bear market. It crushes it in a bear market. I've spent the past 6 months running tests on secret market patterns, and I've isolated the top 5 out of 64 that have dominated over the past decade during all market conditions. It doesn't matter if the market's long, short, bull, bear, it makes no difference. These things hold on average of 2 to 3 days, I think 4 days, I think 15 days max in 20 years, but I think average trade is like 2-3 days. Punchy, quick, swing trades, just what you need in this kind of market. Click the link below to learn what this trading strategy is all about. Follow the link below. Tomorrow, top ETF and top option pick. Bye, guys. Talk to you soon. Post some comments, feedbacks below the video. And remember, top stock, LNTH, bottom stock, Chewy. Bye, guys. Take care. Have a great, great day.